Hello, my name is Mark Winmill. I'm CEO of Global Self Storage Incorporated. We are a NASDAQ listed self-storage REIT. Symbol is SELF, S-E-L-F. We own approximately 1 million square feet of storage properties, primarily in the Northeast, Mid-Atlantic, Midwest, and South Central areas of the country. What are the current prospects for self-storage investment in the United States? The prospects are very good. The industry is outperforming. The sector is outperforming and has been for the past 18 months through the pandemic. Although not exempt from the challenges posed by the health crisis, self-storage properties have demonstrated remarkable resilience to the challenges and the various impacts of the pandemic. Prior to 2020, the sector was contending with the detrimental impact of record construction activity on rents. There was in fact pressure on rents and revenues. However, through the pandemic, the swift adoption of remote learning and working practices, as well as migration to less dense areas, created new needs for storage units. And this jump in demand helped lower the national vacancy to a multi-decade low, which is 5.5% June as end of the Q2 in 2021. And the average asking rent for a 10 by 10 is climbed from a low in the second quarter of 2020 of $1.13 per square foot to $1.24 in June of this year. And that value hasn't been seen since 2016, which was in the beginning of the construction development phase. So these demand drivers are transitioning and creating a very, very good environment for self-storage. And investors have been capturing the benefits of this record performance. Investors should look for continued performance from the public REITs. The rebound in rents, which is being exhibited across the country, really is benefiting all of the public REITs, including us. We're very geographically focused in secondary and tertiary markets, which of course have benefited from that migration from less dense areas, the primary cities to suburbs. But all of the self-storage REITs have their various and different focuses, and they've all benefited. So you should look forward to continued performance from all of them. When COVID-19 infections started up in the spring of 2020, the industry was knocked back like everyone else in all the different real estate sectors. But as time went on, the industry showed its traditional resilience and came back strong, and as the new demand drivers emerged. The new demand drivers from migration out of the cities to the suburbs, students packing up from school, storing their stuff in units, going home, various folks in their houses accommodating additional family members created need for storage. People relocating, people moving, the act of moving, that quite a lot of movement from cities to suburbs and from apartments to larger spaces. And then subsequently, creation of home offices and storing items to create the home offices. All these were new demand drivers that created new demand for storage. As this, at the same time, the development came down slightly from 2018 and 19 down in 2020 and continued a lower trend. So you actually had slightly less new development and new supply coming on in all sorts of markets and rents going up. And and that's a very favorable backdrop for the sector. So coming out of, here we are 18 months later after COVID, and we have all sorts of new demand drivers for storage, the suburban relocation trend, and all these favorable demographic trends are very beneficial to storage. Well, the recession-resistant nature of self-storage has attracted investor interest, investors new to the property type, and that is driving continued development. So there will be continued development to meet this new demand. Here we are with the lowest vacancy, 5.5% or 94.5% occupancy, the highest in decades. So two things will happen. Rents will go up, street rents or move-in rents will go up, and new supply will continue to make its way into all of the markets, primary, secondary, and tertiary across the country and all the different MSAs. So we believe that supply and demand will be will not be too much supply or too much demand. It will be in pretty good stead and will continue the growth for overall revenues for investors. And it will be the momentum in place will continue into 2022. But it's hard to figure out which part of the country is going to benefit best because everyone is doing so well. There is a migration from from the cities to less dense cities or suburbs, and that is in effect many different markets. Global self-storage is ideally suited for that. We tend to locate in secondary and tertiary markets and suburban markets, and but all sorts of areas are doing well everywhere from that are growing in population, like Southeast Florida and Texas, but also places like San Diego, Indianapolis, Chicago, New Haven, Connecticut, and Philadelphia. So it's really it's kind of an unusual time in the industry, in that there's growth really across the country in there is no geographic focus of the growth. It's everywhere. And as far as product type, it's more towards climate control, which is what tenants have sort of demonstrated their preferences for climate control units. And that's what we're seeing. Maybe the sort of very general statement that the favorable demographics, migration patterns, and behavioral trends all point to a positive outlook, not only for self-storage, but a couple other sectors like apartments and industrial. And that's what we would, we're very, I think, lucky to be part of that positive outlook going forward. So we would think that some of the challenges that we can't forget continued to be the Delta variant of COVID and supply chain challenges. Tax reform is a big concern for a lot of people. Inflationary pressures and prospects of rising interest rates. So investors always have to keep an eye on things, and those particular challenges will continue to be with us.